Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. What is one of the best ways to self-insure for long-term care? Now, first off, keep in mind, self-insuring for long-term care is risky because you do not know the answers to three very simple but important questions. When will you need care? How long will you need care? And if you have a spouse or partner, how long will you live, or how long will one spouse live after the other spouse has needed care and passed away? Now, long-term care insurance is valuable because it answers all three of these questions. When will you need care? It doesn't matter. With most long-term care insurance policies, not all, but most, 100% of the policy benefits are available to you from the moment you're approved. How long will you need care? There are some long-term care insurance policies with an unlimited amount of benefits. So no matter how long you might need care, it'll never run out. But for less premium than an unlimited policy, couples can often buy policies that share benefits that last maybe 10 years or 12 years or even 16 years. Keep in mind, every dollar used to pay for care is one less dollar available to generate retirement income for the surviving spouse. Your retirement assets cannot simultaneously provide a stream of income that you'll never outlive and also be liquidated at the same time to pay for long-term care. That is one reason why I refer to long-term care insurance as portfolio insurance. So what is the best way for some people to self-insure for long-term care? The answer is asset-based long-term care insurance. These products provide a lot of leverage and tax-friendly ways to fund future long-term care expenses. There are lots of options. You can fund these products with cash value life insurance, and in some cases, you can avoid paying tax on the gains in the life insurance. You can fund these products with deferred annuities, and in some cases, you can avoid paying tax on the gains in the annuity. You can fund some of these products with a partial transfer from your traditional IRA or 401k. These products can be funded with one single premium or annual premiums or monthly premiums or a single premium in combination with annual premiums. If you choose an annual premium, you can set these products to have premiums that are payable for only 5 years or payable for only 10 years or payable for only 15 years or 20 years. You have lots of choices. And these products can leverage your assets to pay for long-term care. When you self-insure, $1 of assets pays $1 of long-term care expenses. With asset-based long-term care products, $1 of assets can potentially pay $2, $3, $4, or even $5 of long-term care expenses. Since the asset-based products can leverage your assets, we can turn a couple $100,000 into $1 million of long-term care benefits or more. Some of these asset-based products even have a long-term care benefit with no lifetime cap. It will pay long-term care benefits for however long you or your spouse partner may need care. And if you never need long-term care, your beneficiary will get something back. You can tell from my descriptions, these products are very flexible and offer lots of options. That is one reason why they are so popular. And with many of these products, the underwriting is relatively easy. Usually just a short telephone interview with a nurse from the insurance company. No blood samples, no urine samples, no medical records required. Why is the insurance company willing to do this? Well, if you need long-term care, the asset you use to fund the product pays for roughly the first 2 years of your care. In other words, the insurance company uses your money to pay for the first couple of years of care that you need. They incur essentially no risk until you need care for longer than 2 years. So the insurance company is making money on your money, but they pay less than what the insurance company can make on their investments. Now, cash value life insurance is usually a horrible investment. Deferred annuities are usually mediocre investments. However, these asset-based long-term care products are not purchased for investment purposes. They are assets. They do have cash value, but these asset-based long-term care products are purchased to help protect your other investments from potentially catastrophic long-term care expenses.